You actually recently changed your view on the euro to actually increase it, seeing a likelihood of 110 rather than 105 previously versus the dollar, because not euro strength, but dollar weakness. Just pairing this with what we were hearing from Laura Jane, how much do you see this hinged from U.S. weakness versus just simply rate cuts that might be beyond what people expected?
Well, there's obviously a lot of different stories interlapping into the euro-dollar story. But I think, if we go back to the start of the year, we'd always had the view that the dollar would weaken towards the end of the year because that's when we were anticipating that the Fed would start cutting interest rates. And so we're coming up towards the end of the year right now. And, it is our view that we are likely to see a Fed interest rate cut in September. But, I really must caveat that, because if we go back a week when we had the market anticipating really aggressive Fed interest rate cuts, we were never of the view that that was going to happen. I think what we saw a week ago was a combination of a lot of different factors all coming together, and one part of that was positioning. The market was too positioned in the carry trade, too positioned short the yen, too positioned perhaps long in tech stocks, too positioned perhaps in US equities, and I think a retracement happened all at once, which created the chaos that we saw. But our view all along is that, we'll have some moderate Fed interest rate cuts towards the end of the year, and we're still of that view.
How much do you think that some of those carry trades have been fully unwound? How much are left?
Well, that question, again, needs to be put in some sort of perspective. How much should be unwound? I mean, certainly if you were in the carry trade, maybe at the start of last year, you'll probably still be in the money. I mean, certainly if you look at some currencies, maybe MEX against the yen, currency trades like that. I think we have unwound more or less everything that we are going to unwind right now. And the reason for that, particularly when we talk about dollar yen, is because I think the market has to still settle down in terms of the views on the Fed. I think the market was far too excited a week ago in pricing in too many Fed interest rate cuts. The data this week clearly in terms of the US economy is going to be really imperative of giving the market a lot more balance in terms of what is really realistic from the Fed. And at the same time, well, yes, maybe the Bank of Japan can hike interest rates again, but maybe that won't be till the start of next year. So from that point of view, I think a lot of the really extreme positions, and there was a lot of them, have been washed out right now. And I think maybe dollar yen can settle out, maybe still relatively volatile, but nothing like what we've seen. So maybe 145, 147, that sort of trading band, until we get more data to really clarify what the fundamentals are suggesting for that currency pair.
Jane, is there some degree where just the carry trade isn't attractive now, that it's linked to low volatility? And if we're entering a summer that's already been volatile, if we're entering a period of politics, and as you mentioned, the uncertainty over the Fed, that even when trades do unwind, they won't be put back on?
Yeah, I mean, you are right there, because one of the reasons that the carry trade has been so popular in FX this year has been because volatility has been, really very low. So if you enter into an environment with higher volatility, high news events, and certainly, the Fed and the US election are really big news events for foreign exchange, there is the likelihood that those sorts of trades will become certainly, less fashionable. And we're not, I would expect, going to go back to the situation that we were in, maybe about a month ago, with everybody and their dog, short of the yen. I don't think anyone's really anticipating that's going to happen. But, at the same time, it is the nature of foreign exchange that there is going to be some degree of carry trade in there, but just not as popular as we were just a few months ago.
Jane, last time you were on, we talked about the dollar and what it means for this Trump trade, and how sometimes the policies Trump talks about means a stronger dollar, but he's been on the record talking about how he actually wants a weaker dollar. Do you have any idea on how the dollar would trade with a Harris administration?
Well, I think we've already seen some of this coming through. The Trump trade, we all started talking about it hugely, of course, after that debate between Biden and Trump. But now that Biden has stepped back and Harris is there, and Harris is doing better in the polls than Biden was doing, then the market's obviously scratching its head and thinking, well, maybe we were too hasty in pricing in this Trump trade. So, if we assume that Trump would bring in more aggressive tariffs, if we assume that there was more chance of tax cuts under Trump, well, they're inflationary, therefore it's suggestive of less Fed cuts, and therefore it's more dollar dollar positive. We can assume perhaps that Harris would be more friendly in terms of her allies when it came to tariffs, because I think the direction for protectionism is still going to be there, but perhaps less so under Harris than under Trump. But if we assume that there is less reason to panic so much about tariffs, then we've got to assume that maybe the Fed is going to be able to cut interest rates a little bit more, and that's dollar negative. But of course, putting a spanner in the works is the Trump and the Vance dialogue about the president should be able to control interest rate policy. Now, I don't believe that would happen, but if it were, then we're looking at a completely different outlook for the US dollar.